Hello, we are going to look at what we mean by put options. So this is an introduction to put options. So when we hold a put option, the holder of a put option has the option or the optionality to sell the underlying asset at a fixed price in the future, but not the obligation. In other words, when you hold a put option, you have the option to sell a particular asset, the underlying asset, at a fixed price, which is part of the option contract at a future date, but you're not obligated to do it. If you decide it's not profitable for you, you don't have to exercise your rights. So if you look at here, basically, let's assume that the underlying is a stock. So the stock price is quite volatile, you can see here, and this is the strike price of the option, or the fixed price at which you could sell this particular stock. Now in this case, you will not use your right to sell the asset at K is here, because you're better off selling at the market price, because the market price is much higher. You can see the stock price, even though it's volatile, the market price is still much higher than the strike price in the put option. So why would you sell at a low price when you could get much more by selling at the market price? So in this case, you will not exercise your put option. But in this case, you can see now the stock price is falling. Once it falls below the strike, if you exercise your right, let's assume that this is a European option. Remember, a European option, it's only exercised at maturity. Compared to American options, it can be exercised anytime. So let's assume this is an European option we are talking about, because it's quite easy to understand the concept. So in this case, at maturity, you can see the underlying has gone below the strike. So you can exercise your put option, and the value of the put option is the difference between the strike and the underlying. So here the put option becomes valuable. Actually, after this point the put option becomes valuable, because you can see there's a difference between the underlying and the strike. So that's what we are saying here. Now when we talk about a particular option is in the money or a particular option is out of the money, what we are trying to say is, when we say out of money, what that means is the option doesn't have any value at that particular point in time. And when we say option is in the money, what we are saying is the option has value at that particular time. In other words, the option can be exercised. So for a put option, if the underlying price, so this is the underlying price, is above the strike, so this is when you are holding a put option. Let's assume you have a long position in a put option. So this is the strike price. So this is the strike price. Actually, that's the strike price. So for a put option, when you're holding a put option, if the underlying doesn't go below the strike price, then we say the put option is out of money, out of money option. It's an out of money option. But if the underlying price goes below the strike price, then we call it the option is in the money, because suddenly the option becomes profitable. In other words, if you exercise the option, you'll make money, because you'll make profits. So that's the difference between in the money and out of money. And of course, if you're buying an option which is deeply out of money, in other words, it has a long way to go before it even reaches at the money and then in the money, the premium you will pay will be much less. The closer it gets to in the money, in other words, if you're buying an option, if you're buying the put option somewhere here, the premium will be more than if you're buying the put option somewhere here, because you can see that the stock price has to travel all the way below this point in order for the option to become profitable. So you can see, when someone is purchasing a put option in order to make money, one of the view is that the underlying is going to drop below the strike before the expiry of the option. So that could be one of the expectations. I mean, there are various reasons an individual would enter into a put option, but this is one of the reasons. So finally, so this is a payoff diagram of a long put option. So remember, when we say long, that means we have purchased the put option. So these are the values of the underlying, which is the x-axis, and the profit sign the y-axis, that's profits. So you can see a put option is only valuable if your strike price, that's K, if your strike price is above the underlying or the spot value of the underlying. So a put option is only valuable if the strike is more than the underlying. So that's the reason when the strike is less than the underlying, you can see strike is $5 here, and when the underlying is $5, $6, $7, and $8, the payoff is 0, because we will not exercise the option because the option is not valuable. For example, if you look at this one here, why would you buy the asset at $5 when you can buy it at, sorry, why would you sell the asset at $5 when you can sell it for $7 in the market? So you're not going to sell it for $5 when you can sell something at $7, so you will not exercise your option. So that's why the payoff is 0. Still, the premium is negative. Remember, whenever you purchase an option, you need to pay a fee. So that's a negative sign here, and because of that you make a loss anyway, even though you don't exercise the option. It's like a fixed cost. So the only time the option becomes profitable is here, when the underlying is lower than the strike. So your payoff is $1, and then after you take off the premium of minus 0.2, you make a profit of 0.8. So that's what you can see. The diagram looks like this. Now this is a put option which has a long position. Now if you take a put option with a short position, the diagram will be opposite. So it will come like this and then go this way, which means the losses can be huge when there's a drop in the underlying. For a put option with a long position, you start making profits when the underlying falls below the strike price. When the underlying falls below the strike price, you start making profits in a put option.